Good morning, everyone. I'm Martha Stokes, and I am delighted to be here today to help you understand what's going on in the market from a professional of the market. I'm retired and I just love to teach people. I'm so happy that a lot of you are letting me know that you're interested and you're curious about different things and how do we figure things out. One thing I want to show you today is there are certain indicators that are totally different than the ones you're using. If you have certain indicators that you really like, that's great. But what we're tracking here is the giant buy side institutions, the sell side institutions, uh, the giant global asset management companies, this sort of thing that other indicators do not track. Now, volume always is critical because volume can tell you more information. We have when we have accumulation going on, oftentimes volume will drop lower. It's usually high when there's speculation from small funds managers, and there's 10 to 15,000 small assets and small funds managers, and they have no idea what they're doing. They go on YouTube and Instagram and other places and promote themselves and promote their companies, but they don't have any formal professional education. The professional side of the market usually has a financial services degree, and then most of them end up who want to do more trading and more activity like that, or be able to apply for a floor trader, they may come to me for the education on how to trade stocks. A huge difference between long-term investing and trading stocks. Buy-side institutions are long-term investors, and volume is usually very low when they are accumulating because they accumulate over time. It's very intermittent. Sell-side institutions, which we're going to talk about today, are floor traders for the big money center banks or Goldman Sachs or other giant financial services companies, and also the asset management companies that are global, BlackRock, State Street, that sort of thing. So it's very important that you be able to determine who is in control of price. And that is part of what I try to teach with the market participant group cycle. I am a cycle theorist. I'm told I'm one of the most renowned ones in the US or whatever, but I really don't pay any attention to that because I don't want to be famous. There's no fun in that. What we're looking at is CVX today, and we're looking at it from the sell side institutions' point of view. Sell side institutions favor oil and gas because they trade the commodities market and they trade the options market and they trade other markets. They are always short-term traders, unlike the buy-side institutions who are long-term investors. They may slowly accumulate, but the sell-side institutions are short-term traders. They're not approved to actually hold things for a long term unless the big bank has a division that is an investment division. And a lot of those are kind of going away. It's a difficult mix for a big money center banks. They have floor traders. They have hundreds of floor traders. And you're thinking, well, why don't they use AI? Well, because it doesn't work. AI can probably find an engulfing white. It can probably find a morning star or an evening star. It can probably find a dark shadow or whatever. But that doesn't tell you that the stock is at a point where it's going to move up or down strongly for short-term profits. It just can identify the old candlestick patterns, and there are new candlestick patterns that are in this mix. And what is important is that you need to learn these new candlestick patterns that aren't in the old 1990s to 2000 candlestick books that everybody follows and reads and studies. Okay? The candlesticks have changed. Why have they changed? Because in 2002, we went from fractions to decimals. That made it a penny spread market. With a penny spread market, you can't scalp. You can't make any money in it. The professional traders all went to swing trading. So the sell side institutions, the money center banks, are either buying long for short term profit or selling short to make the market and make huge profits. They make more money on the downside than the upside. CVX was an oil and gas company. They were buying and they were causing nudges and pushing things up. We can see from this indicator whether there was heavy accumulation or selling. Sell side institutions were buying this stock and nudging it up. And then when they saw that it was going to turn, and I was warning some students about that, you have to be prepared for the sell short. The sell short enables a floor trader to place an order and let it sit there. It can sit there for a long period of time on the intraday or whatever, and it doesn't necessarily get triggered. It can also be removed within a millisecond. So they are trading the millisecond, you're trading the 1 minute scale. That is a disadvantage if you don't understand what's going on. We have some sell side institutions pushing this price up. It gaps down a little and then it goes up again. Then they suddenly decide they're going to start selling short this stock. Much more money in this. It doesn't matter whether it's a minute scale on your scale, because that's all we can do, or a day or a week or a month or a year or whatever. They will place a sell short order. They're going to make a huge amount of money because people are panicking and it's starting to go down. And they would wait and wait and wait and offer a buy to cover well below the price if this was intraday. Let's pretend this is intraday. And so they would just wait and wait and wait. And then the buy to cover is down here. They're making the market. They make the market by selling short at a very high price and letting the stock collapse. It doesn't necessarily have, it's very low volume. This is not a lot of volume going on, even though this is intraday. And they'll just let it collapse and then they'll buy to cover. Now, most traders don't know how to sell short, so it's a huge problem for you because you always lose money. You have to understand when we're in a selling position, the sell side institutions are the ones that are controlling the selling down, not the buy side institutions. They're in it long term. They're not selling this stock. If they were in it, they're not in it very much. Their percentage of shares held is only about 72%, which is moderately high because it is a stock that they have in ETFs and so on and so forth, and they have to hold those in trust funds. So you have them selling short and buying to cover. And that is important to understand. Meanwhile, we see that there is some steady, slow accumulation going on against their action. Okay. So this means that there are some professional traders in this mix, and there is some buy-side institutions accumulating it, probably for inventory control. Then right about here, we have another big sell down. Now, we can see that the institutions are slowly rotating out of this, and so the sell side is preparing to sell short again. This is a complex subject matter, so if you don't understand it, it can be confusing. But what you need to know is that when there are lots of little black candles and the market is, there's a bounce, these are all bounces. This is small funds managers selling on the bounce or buying on the bounce, whatever. But this is selling down, and the sell side institutions have control of price. Now we have a strong support level here, and that's why the selling down continued, but now is starting to bounce up a little bit because they're buying to cover. And they will do that at any strong support level. Why? Because this was a buy zone, and the sell side institutions know that the buy side institutions are going to start accumulating this stock at this price level. That you may even be in a little bit earlier. Okay. So right now we have some distribution. This is sell side institutions selling the stock short, and they are very savvy. They are the smartest, most well-trained short-term traders in the world. The U.S. has a vast JP Morgan, Bank of America, Wells Fargo, Citigroup, all of them have huge floors. I've been on them. They're giant floors of floor traders actively trading. They can automate, but they are not using AI. So why are you trying to use it? Because can be very, very dangerous. If you asked an AI to tell you what this meant, it would not be able to do so. If you asked your AI to look for an engulfing white or whatever you're looking for, or a sell side dark cloud, whatever, it could identify it, but it can't identify how long that run is going to be, how much profit potential you have, where are the risk factors, where is the support, where is the resistance, whether the sell side institutions are in control of price or whether it's the buy side institutions that are in control of price. The AI doesn't have that capability, and it's going to be a very long time before it can have that activity. This is why I take my time once a week to try to teach you some of this information. And today was a mind twister. It's going to be mind boggling. I'll go over it again and again over time so that you understand it. This tells us what's going on with the institutions. It gives us information about money flowing out, which was right here, then a little bit of accumulation here, probably for ETFs, then more selling out. The sell side institutions are controlling price as it sells down. They will stop because there's this huge fundamental level that the buy sides will start buying the stock in. So be aware of who you are trading with and who you are trading against. I'm Martha Stokes, and I'm out of time again. Thank you for joining me. I have so much fun sharing my information with you, and trade wisely.